Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. This week we're going to talk central bankers with the news that President Joe Biden has finally reappointed Jerome Powell to the chairmanship of the Federal Reserve. I think this is a good decision. It emphasises both continuity and avoids an overt politicisation of the Fed. The President also announced as Vice Chair Lael Brainard, or Professor Lael Brainard of MIT, a widely respected economist. She was brought up in Europe by American diplomatic parents and brings an international component to Federal Reserve thinking. I think she's a potential future chair. The ghost of the feast, of course, was inflation. 6.2% headline numbers in the States, 4.2% here in the UK. And the burning question for all central bankers, do we need these crisis-era policies in what is now a booming, almost red-hot world economy? That's the question that I'll be asking in the slides ahead. And as the interest rate air gets thinner, what does this mean for financial markets? The drumbeat of tighter monetary policy around the world is getting louder. As you can see in the right-hand panel, 12 central banks now have raised rates this year, with second rate rises from New Zealand and South Korea announced last week. Meanwhile, the US Federal Reserve is signalling that it might shift its transitory inflation language. This would mean an earlier end to taper and the start of rate hikes in 2022. You can see that language emphasised in the minutes of the Federal Reserve's November meeting there in the left-hand panel, and in a speech from Fed Governor Christopher Waller. He said the rapid improvement in the labour market and the deteriorating inflation data have pushed me towards favouring a faster pace of tapering. It's not all about supply shocks that's causing this, it's also a demand issue. Look at the sharp upward shift in nominal retail sales after the COVID crisis, climbing to a record high of 638 billion. On the right-hand side, you can see that that climb in retail sales far dwarfs even the imports that are coming in, hence causing this tightness in product markets from a demand pull perspective. Also, of course, increases in stock market prices and housing prices are increasing the wealth effect around the US and other Western markets. If you look here on the left-hand panel, I've plotted US real estate and financial assets as a percentage of disposable income. You can see the levels in the dot-com bubble, in the housing market bubble of 2008-9, and look at the level today, new records. On the right, I've put households' net worth, again new records. So this inflation of financial assets causing householders to go out with confidence to spend and consume. So where is the greatest risk? Well, I think the pressures are most in the labour market. Certainly that's what Andrew Bailey of the Bank of England said last week. It's tightness in the labour market that concerns me most. In the UK, this is pretty extreme. In the left-hand panel, I've shown the number of unemployed people per vacancy. Back after the financial crisis of 2008, that reached over 5.5 people for every vacancy. Today we've got just 1.3 unemployed for every vacancy. Now if you allow for people moving between jobs, that's pretty near in one vacancy for every unemployed person in the UK. Put in another way, if every unemployed person took every vacancy, there'd be zero unemployment. That's also been exacerbated by what we're all starting to call the Great Resignation. These huge numbers of people leaving the labour market to go into self-employment, many of them in the tech and virtual space. Look at the UK labour flow statistics on the right, reasons for job moves as resignations, the highest since the records began. The final reason for the strong demand which we expect to see in the world economy going forward comes of course from the climate agenda. The COP26 conference may have been long on promises and short on achievements. What it did highlight is the extreme need to accelerate spending from right now up until 2030. That's that red bar I've shown in the left-hand panel, the ambition gap, if you like. To fund that, I've shown the sort of requirements we're going to need in the right-hand panel. That rapid rise in spending, up to about 7.5% of GDP by 2040, the biggest capital investment boom the world has seen since World War II. So what does this mean for financial markets? Well, you can see on our regular dashboard that equities continue to lead the pack, but they've consolidated a little bit over recent weeks, reflecting this tighter money agenda. In the bottom of the panel, you can see gold and bonds still lagging. On the right-hand panel, you can see value and growth now neck and neck for the year to date, and volatility as measured by the VIX hovering around 18. So what does this mean for our policy agenda? Well, first of all, it's another reason to keep underweight bonds and avoid those rising yields, which are going to become a multi-year phenomenon in our view. Second, continue with an overweight in equities, but be cautious in your equity selection. Quality, thematic drivers and dividends. We saw another extremely strong quarter for dividends, with 90% of all companies worldwide raising their rates. That's almost unprecedented. Finally, in alternatives, continue to hold inflation plus income streams from renewables, from infrastructure, etc. around the world. Well, I hope that's helpful, and it shows you that the drumbeat of tighter monetary policy around the world is getting louder. And while this doesn't necessarily argue for a lower equity content, it does argue for some caution in equity selection. We're looking at strong thematic drivers, we're looking at quality, and we're looking at robust earning streams and dividend flows. Well, I hope that's helpful. Thank you.